Thank you for joining iMeet. When you hear the tone, you will be the 28th person to join the meeting. The meeting is now being recorded.
Hey everybody, good afternoon. This is David Blake with Tuesday Tech Talk. Sorry I missed you last week over the holiday. We'll try to pick it up today, and despite having a bad cold here, and see if we can try to formulate a little bit of a game plan for the end of the year. If this is your first time here, we usually talk about, I try to keep it down to about 20-25 minutes, and then we open it up for some questions. You can ask questions about individual stocks, industries, targets, anything else on your mind. So we're going to jump right into it. Right in here. Again, this is the Dow Jones as of this morning. We're still in a bearish market posture, which you may question, but the CTI is negative. It's a -1. It will be a -1 this week. It only dips to a -3 on this cycle, which means that you usually don't get much of a pullback on that. And even if we would pull back to the 50-day moving average on either the S&P or the industrials, you're only talking about a 2% pullback. So this isn't something where we're going to want to load up on the on the short or anything like that. But might just means that when the CTI is negative, that you may take a little bit of a cautious approach, and you're not as aggressive as you normally might be. Okay, our momentum index improved last week to a neutral -3. That was from a negative -7 the week before, when we had a few weeks of the Dow going down. Sentiment index is still a -1. A little bit too much bullishness still out there. So last week the major averages punched out a new high. It was confirmed by the internal breadth with the NYSE AD line making a new high. NASDAQ and Russell 2000 were higher for a second week. The gains were led pretty much across the board to the technology, industrials, consumer discretionary, energy, after crude oil hit a 2-year high, which we've been talking about that for the last couple of weeks here. We'll go into some more of that. And but first, let's look at the Dow here. The most glaring thing on this is, we often talk about negative divergence, and get my pointer here. What a negative divergence means is you have the index moving up to a new high or a stock, but you had the momentum indicators, especially the 14-day RSI, failing to confirm that, and it doesn't make new highs. So this is something you want to have a little look at. We had the MACD, which kind of measures the strength of the trend, was also negative during this time period, meaning that there just wasn't any kind of a trend really going as it was coming down. But things are improving a little bit. This doesn't have today's 100 triple-digit pop, but it's we're getting up here close to this 23,700 and something in here. But this negative divergence is something we want to keep our eye on. It should keep you a little bit cautious. It just means that momentum is slowing, and when all of a sudden you have a triple-digit day like today, it should make you just hesitate. When you have a move like this, you don't start thinking over here when the market breaks out. You don't start thinking, hey, I got to get in here now. I've missed it. We've had a heck of a run here since May, and over the last couple of months, when everyone was calling for a market pullback, we thought that we would be positive, and we had a pretty nice run here during September or October. So don't expect this thing to be flying up here to 25,000 and higher. Don't be afraid if you miss a few points to the upside. I think we'll have time to get back in here between now and the end of the year. The S&P 500, here you had that channel you were working up here for a while. You had a little bit of a another throw over. We broke out to the new high the end of the week last week. But again, as this thing's pushing up to new highs, the 14-day RSI isn't able to participate. The MACD is showing that the trend is trendless basically. And but you are getting some improvement over here where you may see this thing pick up a little bit. So it's not a chart that you want to short, but it is something that when you see this, you just take a cautious approach to it. Now, going over into the NASDAQ, I'm sorry, before we get to that, this is the NYSE Advanced Decline line. We had looked at this over the last 3 weeks where we were getting, waiting for this thing to break down a little bit more, but we got a big push up here during the holidays. It was, even though the Dow was up yesterday, we still had about 700 units declining, more declining than advancing. So this is picking up. It broke out to a new high. That's a positive. That confirms that we could get some higher prices. In addition, we're back to expanding last week in the 52-week new highs and new lows, which we'll watch that. And again, we're still in triple digits today. We're sitting at about 150 again. When the market's starting to break out to a new high, you usually want to see that around 250 or so. So it's good, it's solid, nothing really to worry about in here that you need to move to the sidelines. But we'll get into later with the game plan here. I'm not rushing out to buy anything, but you certainly want to hold on to what you have at this stage. Here's the NASDAQ, an even better looking chart. A couple things to notice here. As we're making new highs, higher highs and higher lows, you don't see that negative divergence in the 14-day RSI. This is confirming the move higher. The MACD is confirming that the trend is bullish, and this is my 30-day stochastic that I look at. As long as you're above 80, the trend is strong, and we've got a ways to go on this thing. So NASDAQ still looks like the strongest index out there, which includes a lot of the technology and some of the other biotechs and things like that. Okay. Now here's the advanced decline line for the NASDAQ. It really had a lot of deterioration through here, but we bounced back last week, although it was a holiday week, and we're getting to a seasonally strong period. But I'm not the only one that notices, but this year the seasonality patterns in the market have not really worked out very well. This is September and October on the advanced decline line right in here, and you see that was whenever it was expected to be weak, and we just plowed ahead. Now, I do think that, especially on this thing here, if we don't make a new high on the AD lines, that would be another little bit of a cautious red flag, but nothing much. I mean, the move to a new high last week is confirmed by this. And here's the NASDAQ, new high, new low. You also had a big confirmation with that right now, an expansion. So, again, we're not looking at this thing to be rolling over. Just a little bit of negative divergence that we see in there. We want to be cautious on that. Here's the Russell 2000. We'll look at one more index after this. Again, we have a little bit of negative divergence, but I'm not that worried about this because of this the length of this flag pattern, whatever you want to call it. And we had to break out to a new high. That's bullish. If this thing comes back down here below the 1510 area, that would be a little bit of a cautious. The pivot point is at 1500. So as long as we stay above 1500, I think we can work our way longer than that. And this gave a buy signal on the MACD, which is good. Now here's the transports, and this still doesn't look very good. A couple of things I want to point out here. We have this triangle pattern coming up here. You've struggled. You fell below the 100-day moving average right here. You can't get up to the 50-day. Although if you do break above the this descending line, you could get a shot to go back up there to the to test that. And today we're at let me see, we're up 96.72. So you're still not up to the 50-day yet, but you are right around. You are starting to break through that descending trend line. So we want to keep an eye on that. We want to see if we can hold that or not. A couple of problems down here on the 14-day RSI. We always want to see this while it's having a little bit of a pullback. We want to see it stay above 40. And we didn't get that. We came down into 30. If this thing is going to start to new leg up, you're going to want to see this the 14-day cross above 65 or 70 to show that now the bulls are back in control. So this is still a little bit of a question mark, and a break below that 100 is going to be a negative chart pattern anyway. Now you saw back here, going back to the Russell, going backwards here, we did break below the 50, came down, almost challenged the 100, but it bounced back pretty rapidly on that last week. So it did stop the bleeding at that point. All right, so for the week, pretty broad-based market move last week. Utilities, technology, industrials, consumer discretion, healthcare, none of them up a lot, but everything up a decent amount. Financials lagged the overall the broader market, and consumer staples also were lagged a little bit. So let's get into this thing now. We're going to look at the different sectors today, and we're going to go over a couple individual stocks that people emailed in. But what I want to talk about, the reason we're going to look at these different sectors is because we want to find out if we've seen any cracks out there in the broader markets. In other words, okay, we've had a heck of a year. You should be one of the better market returns that you've had here in a couple of years. And what we want to concentrate on today is I don't want to have this thing all of a sudden take an 8% drop or 5% drop when we give up our returns. So we're going to talk a little bit about that and how we want to be positioned, and by looking at the different sectors and then digging a little bit deeper and seeing which industries in those sectors are strong and which ones are weak, we can tell which holdings we want to hold on to and let this market take us out on its own, or which ones we may want to take some profits if we have them before it starts to roll over. So first off, we have the technology sector following up this trend line. It's breaking out to new highs again. Okay, we got a little bit of negative divergence on that, but we're staying above 80 on the 30-day stochastic, which means this trend is strong. But the negative divergence is a little bit of a red flag. I do like the fact that we're getting another buy signal on this MACD, and the histogram is also going to go positive. So I think we can probably move a little bit further on this move. Somebody asked me, well, no, they didn't. That's the next one. Big parts of the NASDAQ are going to be the semiconductors and also the NASDAQ biotech stocks. All right, this is something here's the NASDAQ ETF. It's IBB. We talked for a long time over the last year or so. Once this thing would break 300, it was going to be great. We got the break, ran up here, came back, tested it, bounced off that, and we moved up here. Well, now we're starting to get a little bit of a break, which is if you're not really concentrating on this on the biotechs, you may wonder about this. We've already broken the 50, we've broken the 100, and now we're bouncing around the 200-day moving average. And today, with the Dow up 140 points, the biotechs are negative again. So you're getting a breakdown here to the 50 to 200-day, which we want to keep an eye on. You broke below the 40 on the 14-day RSI. You're hanging out below 20 on the 30-day stochastic, which means the trend is still strong. So this is an area that if you are long on this thing and we start to see the market roll over or start to crack, you probably want to at least take some of these profits in your biotechs. Now some of them look fairly strong, but for whatever reason we're getting a test back here. And this this industry on the NASDAQ is a little bit weaker than some of the other issues. All right, now here's the consumer discretionary sector. We were in this range bound over here, and then all of a sudden we hit this breakout here about 2 weeks ago. It was confirmed by the indicators, moving above 80, and new highs on the RSI. The consumer discretionary again is a broad sector that you want to make sure you're in the right places. Now with the XLY this week, we had anything housing or anything building was huge. We had I think yesterday October new home sales were up 6.2%. It hit a 10-year high. Year over year, they're up almost 18%, I believe, or maybe even 20%. So of course the home building stocks are looking strong. The home retail stocks are also breaking out to new highs. Your Home Depot, your Lowe's, that type of thing. Builders, BLDR. That's an area that if you're long this market, just hold on to them. The up move is being confirmed by not only by the data but also by the technical indicators. Also, some of this is also a lot of these retail stores. Retail stores were breaking out to some new highs here. The AEOs, the Urban Outfitters, URBN, some of these stocks like that. They have had a nice run in here. Some of them are up in our portfolio is 20-some%. But there's historically, they start to kind of roll over once you start getting into December, as you start getting closer to the holiday season. So if you've got some nice profits in some of those stocks, you may begin to think about reducing those going forward from here. I think I had that biotech slide in the wrong place. Now here's another stock that sector that we're starting to see a little bit of cracks in. The market's making new highs. You get the healthcare sector, not so much. You're looking over here. We're kind of bouncing off this area here. The support down around the 100-day moving average, but we've struggled. We've been trading below the 50-day. So you want to find, you want to be in the areas that look strong. If you go to the industry group analysis on Market Edge, okay, biotech, pharmaceuticals, they're weak. They're underperforming the major averages. However, also in healthcare products also. But if you look at some medical supplies, that is a group that is at least keeping the healthcare sector positive for right now. But this is an area that if you're long, and you start seeing broader weakness in some of the broader, the Dow and S&P, this is probably an area you may want to lighten up a little bit on this, because this, even though you're getting some confirmation that you could move a little bit higher, if this thing doesn't take out the 50-day moving average in the healthcare sector, and the way biotech's acting, it probably won't. That's an area that you may want to consider lightening up on going forward here at the end of the year. Okay, there's the biotech again. I'm not sure how I did that twice, but anyway, they were in on that. Okay, in the biotechs, somebody asked me about a stock called AXGN, and it's I'm glad they did ask. We recommended this here about 2 or 3 weeks ago. We had this breakout on this thing, and but as soon as we did that breakout, they announced that they were going to do a secondary offering. Now, this is a small cap stock. It has about 33 million shares outstanding, and they did a secondary offering at 21, and the stock still only came back to about 21.75 before it started to move up again. A million shares on that secondary offering isn't much. This company makes nerve repair technology for joint replacements, for elbows, knees, ankles, that kind of stuff. They also do nerve repair work for breast augmentation. That's a new area that they're going into. Revenue is growing about 40%. At this stage, I would look to see if you could get this thing coming back down here to maybe in the 24, 25 area. But this thing, you have the negative divergence showing up here in the MACD and the 14-day RSI. But I think it's a stock that you probably want to own going forward. But I would like to see this come back down. The fact that this thing ran up after secondary and never even came back down to test it is a sign of strength, because these normally when you announce a secondary, a lot of people will short it, expect to cover it down here at the secondary. So if you're long AXGN, I would recommend staying into it, and if you have a chance to buy it on a weakness, I would move into it. It's got a great story, and so it's a very small cap. Also, it only has about 70% institutional ownership, which means as the mutual funds and money managers come in, they're going to be buying this thing. It's going to be some large buys on the upside. All right, here's the industrial sector. Again, we fell back below that 50-day on this thing, so there's another crack. We fell below the 40, but we've come back up here above 50 on the 14-day. We are above the 50-day right now. We want to keep an eye on that. We filled this gap, which is strong, but then we broke through this little downtrend line. Industrials look okay. Part of that, again, is the dollar weakening. In here, you had the euro, I think, hit about I'm not sure. The euro hit another high against the dollar over the last couple of months, so you want to keep an eye on that. As long as the dollar stays weak, industrials, especially the multinationals, you can hold on to those stocks. Again, I'm not a big buyer of stuff right now, but you definitely want to hold on to those. It's still a decent strength in that sector. Finally, we have the XLU, the strong back, again, making newer highs, higher lows. That continues over here. I don't see the negative divergence. Now, one thing that's interesting about this, and also tells you that we may be getting near a little toppy, with it. Utilities usually aren't one of the isn't one of the sectors that's making a new high when growth stocks and all are punching out, and you're talking about raising rates. And we kind of have a back and forth battle going on here where, you know, we raised rates in was it September, and the 10-year went to 2.60. Okay, and then they announced that we're going to have another rate hike in December. So you would think that we should be able to hold up, you know, the 10-year yield. Today we're down to a 2.31, which is means the yield curve is flattening again, which is going to take its toll on the banking stocks a little bit. So I still think you buy the banks on the on pullbacks only at this stage, but one of them's wrong. Either the Federal Reserve is wrong in the fact that they're thinking about raising rates possibly 3 times tomorrow or next year, or the market's got it wrong, and because they've gone from 260 down to 231, meaning they don't think you're going to get those rate hikes. So we'll find out who's right and who's wrong on that thing, but normally the market gets it right. Another caveat to throw in there, I don't believe that a new Fed chief is going to try to disrupt the stock market by being too aggressive on raising rates. So it's possible that once you get this December rate hike, they may talk down a little bit of rate hikes going forward just until he gets into the position. Because again, certainly he doesn't want to come in and crash the market here by getting too aggressive. Now the problem with that is with the economic data that we're getting, like today we had the Consumer Confidence Index hit a 17-year high of 129.5. They're looking for 124. That's the highest the Consumer Confidence Index has been since November 2000. So we're getting a little frothy in here. And again, that's just things get too bullish like this. That's another little bit of a red flag. Okay, let me go here. Now, when we talked about looking at some of these sectors, when these were the strong ones that we just looked at. They're either improving or strong. If you go into the industry group analysis, pull up the first page. You can click on relative strength. It'll sort the industries by strongest to weakest, and you can see where in those sectors you want to be. Okay, home construction, the number one, the strongest industry that we have over here. Internet content, that goes with the tech. Building materials, that goes with the buildings. Heavy machinery, that's the industrials. So you can go down this line and see where you are. Software and processing, okay, another high-tech area industry. Okay, now here's the weak groups. You go in here and you want to see where you want to go, because not everything, energy is kind of flat right now, but you've had some deterioration in some of these oil industries. But you can see over here on the healthcare, even though it's improving, we have pharmaceuticals underperforming the market over here. Here's the medical biotech. It's also underperforming. You can go through here a little bit and find the industries in those strong groups that you don't want to be going into. And if you have any of these, if you have stocks in these industries, I don't see anything wrong with taking some profits, especially between now and the end of the year, because again, a lot of people will start to sell their losers. And if you have a profit in some of these things that have moved up and they're starting to roll over, I think the investors are going to be fairly quick to move out of these. Okay, I wanted to go over one more thing real quickly before we go, because we've talked about the portfolios and stuff that, over the last few weeks that we'll be trying to roll out here next year. We've given you a couple of new buys and new sells. This week we sold 2 stocks in the portfolios. We sold HLX. That was in the model portfolio at $6.91. We took 12% loss on that. We also sold in the small cap growth portfolio, Centene Corporation, symbol CNC. We took a 9.7% gain in that thing. Okay, last week when we weren't here, I came out of the MXI in the sector industry portfolio. We came out of MXI at 67.02. That was for a 7.65% gain. We replaced it with IAK, which is the iShares U.S. Insurance ETF at 65.47. That's basically flat, so I think you can still be buying in that. Okay, now 2 weeks ago also, when we had our last webinar, we mentioned that we were buying LGIH, in both the small cap growth and the aggressive growth. LGH is up 10% since we put that on in the portfolio, which is nice. We also bought CCMP, Cabot Microelectronics. That was in the value fund. That one is up. I think we're up about. The CCMP is about up 3.5% right now. Winnebago went into that same portfolio. WGO, it's up 9.5%. And in the growth and income portfolio, we added LB, which is a retailer, LB Brands, and that was 2 weeks ago. We're up 2.5% on that. And some of these other AEO Urban Outfitters we put in here probably about 6 weeks or 8 weeks ago. And from going forward, I'm going to be giving these things until we actually put these up on this thing. AEO's up 26%, Urban's up about 20%. So we're looking to come out of those when, as the market takes us out. When the CTI is negative, we don't put in any new offerings except in the sector industry because there's always going to be something that's in a bull market. So we'll look at that. I'm going to open it up to questions here in a minute. Actually, before we do, let's look real quickly here at the materials, Select Spider, XLB. A little bit, it's looking okay, but look at the negative divergence again. You bounced off the 50, which is bullish, but the momentum is slowed, and you want to just, again, be cautious in this. If you're long the stocks in the materials, you hold on to them, which includes, some of the oil stocks and that kind of thing. They're also in the energy, but you hold on to these until we get a flip. Now, on the oil stocks we've been watching and buying, I still think you get a play on that to the end of the year. You want to keep your eye on crude oil. Crude oil falls below $55 a barrel. That may be a sign that you want to lighten up and that we could have some problems because we're at the price range right now where the frackers and all will come back on board. And as they come up, that's going to keep upward pressure. I don't see the oil going up to the $65 to $70 range. It's up here in the 60s mainly because of the global synchronized recovery. And that should keep prices probably up around 60 going forward, at least to the end of the year. So if you have those, even though they've had a little bit of a weakness in the last couple of days, I would hold on to them. And XLF, we've been lucky. We've been bouncing off this 50-day moving average. If that starts to break below that, I'd be a little bit nervous. You may want to buy it if the financials come down here around the 100-day moving average. Again, even if we're going into a rising rate environment still, and you have the 10-year Treasury has gone from 2.34 to 2.31 today. Not a sign of strength there or confidence that rates are going to be going up. Okay, now last of all, here's the energy select sector, Spider. We fell below the 50-day. We're kind of bouncing around in here. Negative divergence. Here's that move upward. Okay, it wasn't confirmed by the 14-day RSI. Even break up to there, we got a little bit of a pull, and again, negative divergence in the MACD. You're having some pullovers. Some people are taking profits in energy and oil industries, but I still think we could probably get a little bit for the next couple of weeks. If I'm long on the oil stocks, I'm going to stay long until I see that $55 on crude oil break below that. Okay, I'm about talked out here with my voice. I do see 3 questions coming in here. Oh, wait a minute, I had another question somebody asked. NGL. This is one that we talked about a couple weeks ago as a buy candidate for some of the oil energy stocks. A couple things that are important here. This is a shoulder. This line I drew in here is the breaking of it as the neckline. When this thing had a breakout right here, which would, if you want to, this is a reversal pattern, and if you take the bottom here, which is around 850, 860, and come up here where the neckline was, this is going to give you a target on this thing of right around $15, which would be where the thing gapped down to. So with NGL, I think you can hold on to this thing. Well, again, as long as oil's staying above $55, I think you can probably work your way higher. And we want to see this thing break above 13 so it can make a run towards the 200-day. Okay, that's it. Okay, I'm going to get to some of these questions right now. I buy stocks that are in strong industry trades, strong bicycle opinion, generally sell. The score is -3. Is this a dangerous strategy when CTI is bearish? Yes and no. You don't ever have to be worried about missing the next big move. Like we were bearish, in January and February, and on the CTI, we missed about an 800-point move on the Dow. However, when we came in and started buying a lot of the momentum stocks, the portfolios that we have we're outperforming the S&P 500 and the other benchmarks that we rated them against. So you're going to have a chance to buy. You don't want to chase stuff in here. If as far as the industry groups go, generally a -3 or what I will do also, if they fall below a 1.0, especially on industry groups, if you get the relative strength, if it falls below 1.0 or it's at 1.0, I sell it on two different versions. If it goes to a 0.99, it's gone. Actually, same with my stocks. But if it's a 1.0, but it's still above the sell stop, I will hold it for probably another week. So that's not a bad section. And you replace it with the strongest industry, strongest sector. The thing about that is everything usually doesn't go into a bear market at the same time. So a lot of times, if everything else is rolling over, say we get a rollover in the technology and maybe some of the consumer discretionary. Also, what's going to show up as the leading indicators or leading industries and sectors might be gold. It might be silver, things like that. Where as the market rolls over, it's going to lead you to the groups that are going to outperform. So what your strategy is good. That's what I use on my portfolios with that. Okay, we'll look at Boeing, and we talked a couple weeks about UVXY. I bought a few shares. What's your current view on UVXY? Okay, it's funny because the day after we talked about the volatility, these ETFs jumped about 10-15%, which was good. Of course, then we got into the holiday. Now remember what we talked about. These are like 1 and 2 day trades, and you go into these things in and out unless you start to see get the signals where you wait until what I'd suggest, Scott, is to go in. If you pull up this last week's webinar, in the lower right-hand corner, you're going to see a YouTube icon or whatever. If you click on that, it's going to take you into YouTube, and you can get by the date, which was 11/14. You can go over that webinar again, or we can go back as far. They're all on there, so you can go back and see what we're talking about in different periods of the market. But again, these trades are very speculative. We got to play the next day, and then we started to move up into the holiday. So I think now that we're back down around the 9 area, I think we're probably susceptible to another any kind of bump in here. We might be able to get a thing, but go ahead and let the market start to you want to see a day maybe where we're up 140 points like today, but we don't end up only up like 60 or 70 points. That might be the time to jump into some of the VIX, the volatility things. Okay, I have a question here on restriction in the retail space. Is Amazon to buy at these levels? Well, it's hard for me to buy Amazon at these levels. I mean, it's just, and I don't know if I'm old-fashioned or whatever, but they keep knocking everybody out. However, you have something like it's traded 900 times earnings if they have any at all, and then I guess it's like Walmart is trading at like 12 times earnings, and they're making a run towards Amazon. If I'm buying Amazon at these levels, I'm buying a protective put. I'm going to give up some profit to go with to lock me in. I don't want to get bagged in that because I don't know when. I don't want to say don't buy it because it's so expensive, but they seem to be making all the right moves. Mr. Zhao, I will get to that Boeing real quick here. Any other questions you have, make sure you come in. Let me get this thing so I can stop this, share my screen. What are we doing here? Okay. Again, if you have any more stocks you want to take a look at, throw the symbol out here, and we'll get into them. We good? Stop.
Oh, wait. There it is.
Okay. All right, take a look here at Boeing. Again, you got your negative divergence like you have with everything else here. You're kind of pumping up here to new highs, not confirmed by the 14-day RSI. It's also not confirmed by the MACD. You're really in a trading pattern. I will say this about some of these defense stocks, especially. Even the AD line has gone flat on this thing. I think on the second week of December, some of these may get a little bit of a boost if when the defense budget gets passed. It's supposed to, if it has a big push, you could probably get a pop in that. I might consider taking some profits in Boeing if we get one more pop on that occurring, because a lot of these smaller defense stocks we've talked about in the past, KTOS is one. I expect to see them start to move up here going into the budget talks. Let's see what else we got, if we got any more going in. Okay, I don't see any more questions on there, and my voice is about shot. Again, I hope you got something out of this today. I really appreciate you taking time out of your busy day to join me on this, and hope we can make some money. To wrap it up, let's try to be cautious. Let's not be out here buying new stocks here over the next couple of weeks. Hold on to what you got. We'll let the negative divergence see if it can correct itself. But I think your risk is more to the downside right now than the upside. I think we'll have time to go into some positions towards either last week or the first week or two of January. Okay, we'll talk to you all next week, and thanks again. Bye-bye.